Good afternoon and welcome to this presentation with Tethys Oil. My name is Carl Fredrik Pedersen and I'm covering Tethys Oil from ABG Sundal Collier. Presenting today for Tethys Oil is the CEO Magnus Nordin, and we'll leave the floor to you, Magnus.
Thank you very much, Carl Fredrik, and thank you very much for listening in, and thank you very much, ABG, for giving us this opportunity to address investors also under these rather, shall we say, peculiar circumstances. But we are Tethys Oil, and we are an oil company. And why are we an oil company? Well, we believe that oil will be around for some time to come. It's one of the most important energy sources for the world still, and we believe it will be for some time. Recent production cuts, the strong discipline within OPEC+, consolidation within US shale industry, and not least the sharply lower investment in new production and exploration that we are seeing will certainly lead to stabilization and also recovery of oil prices in the not too distant future. We certainly believe that one should increase investments when prices are low. We have a contrarian streak here, and Tethys has always gone forward in low price environments. And of course, we hope to be able to reap profits when prices return. We firmly believe that fossil-free fuels are extremely needed, but we don't think that the time has yet come. Oil consumption has continued to increase for about 3% a year for the last 10 years. And we don't believe that trend is necessarily broken. But we certainly welcome all the alternatives. And obviously, there is a limit to how much oil oil companies can produce. And we do hope consumers will realize that in the long run. But as Tethys, we will continue to do what we do best. And that is to explore for and deliver oil to consumers, and do this while we maintain a very strong view on ESG and being as sustainable as we possibly can. So that's why we believe we are a good investment case. We offer growth. We just signed a new exploration block in Oman this summer, despite all the adverse situations. We are just about to gear up to drill an exciting exploration well on another block in Oman. We have good cash generation from our star performer, Blocks 3 and 4, where we have done some intelligent deferments of investments while maintaining strong focus, both on finding more oil, but also, of course, maintaining production. In July, we averaged some 10,200 barrels of oil per day, and we just released August numbers at 10,800 barrels of oil per day. Very strong balance sheet. $60 million net cash at the end of June. And we have continued since 2014 to distribute back cash and to shareholders. And more than $120 million has returned to shareholders since 2014. Our Q2 numbers, not our greatest quarter by any means, but certainly not as bad as it could have been. We were still cash flow positive, even after investments, and the operating result was negative, but we continued to generate cash even when we saw the worst quarter for the oil industry that anyone can remember. Our core area is the Sultanate of Oman. We are in this part of the world here, Arabian Peninsula, Saudi Arabia, United Arab Emirates, and Oman. And we now cover actually close to 20% of Oman's surface with our blocks 3 and 4 here, 56, 49 and 58. And 58 is the new addition that we just signed a couple of months ago. We've been active in the country for more than 10 years, and we do believe that we have a good idea of both the workings of the country, but in particular the workings of the geology and the technical opportunities. Oman is very much part of the oil fairway, has been an oil producer since the 60s. A small population, country produced before the recent cuts about 1 million barrels of oil per day. It's not an OPEC member, but a very vivid supporter of the OPEC Plus limitations. Has its own reference crude oil, Oman blend, which trades, historically has traded a little bit above Brent. It's an EPSA regime, that's to say, we spend money, we get money back from production, and we split the profits with the government. Economically and politically, it's an environment that's also very supportive of oil companies. Oil is by far the most important part of Oman's economy, but also very focused on ESG and understands what oil companies are up against, both from the need of the services they require, but also what they can do to limit environmental damage. And of course, be a very good corporate citizen and do what they can for the local economy, where Tethys, of course, is a strong player. So, our licenses, Blocks 3 and 4, it's a production license that we acquired in 2007. It's been around, we have until 2020, and that's where we have all our production from. 49 in the south, an exploration block that we signed in 2017. We're just about to drill a well here later this year, and it's our first exploration well in that block. Block 56, an addition from last year. We signed it in October of 2019. It's oil is known there. We've tested a few wells. We also see a lot of exploration potential, and it's a clear growth opportunity. 58, our most recent addition, an exploration block. Also, previous operators have identified oil, but so far no one has been able to take it to commerciality. We have high hopes, of course, but it's early days. We just signed it, and we are going to see work over the next couple of years. Turn to Block 49. Decent amounts of seismic from previous operators. Very much of a growth case. We believe oil is present. We believe that the seismic is supportive. We have identified a prospect, the Thameen prospect, and we will drill a well down to some 4,000 meters depth to see if there would be commercial amounts of hydrocarbons, gas or oil. We are in final negotiations with several rig contractors and hope to sign a rig in the not too distant future. We certainly expect to drill before the end of the year. It's an exploration block, ample growth opportunity, but of course it's also a possibility that we won't find anything, in which case we have other opportunities. Block 58, adjacent to 49, similar geology, but also offers exposure to plays that we are familiar with from the Blocks 3 and 4 and 56 situation. We have 100%, we are the operator, also a great growth opportunity for the future. We are currently looking at legacy seismic data collected by other oil companies, and we are building our model, of course incorporating what else we have learned from operating in Oman for a long time. And we expect to have more information, of course, as our model evolves, but see some interesting features so far. 56, another growth opportunity. We have wells that have encountered oil. We just tested 3 wells earlier this year. We have an active petroleum system that is confirmed, crude oil of slightly heavy quality, but with decent viscosity. And the seismic coverage is quite good, indicating a number of other opportunities than the ones that have been discovered so far, including such that we know well from Blocks 3 and 4. As you can see here, 56 is on trend from 3 and 4. Data evaluation is very much ongoing, and we expect to get back with both more information on what we can do with the known tested wells, and of course also how the exploration program will look in the future. But Blocks 3 and 4 remain our main and star performer. This is where we have our production. Before the limitations were introduced in May, we're producing above 13,000 barrels of oil per day. We still have that capability. And as I just said, in August, we achieved 10,800, and we are able to go above that when and if allowed. But we are fully prepared that we will have limitations for at least the rest of 2020 and possibly longer, depending on how OPEC Plus looks upon that, and also what, of course, happens with oil price and supply from other sources. We have a number of fields in production. The first discovery, the Far South field, is still ongoing, has been in production since 2010. And the latest discoveries we did was the Ulfa field in 2017, which was brought on stream in 2019 and is still ramping up production. Good quality oil, average from between the various fields is about 40 degrees API. In 2020, operations right now, of course, very much colored by the COVID-19 situation. We have deferred a number of investments. We have cut down on capital expenditure, but we're still focusing primarily on the production and exploration opportunities. We expect, or our target is to be cash flow neutral after investments for the year, and at current oil prices in above 40, we've seen now for most of so far in the third quarter, which is better than we saw in the second quarter, of course. So our long-term exploration and production ambitions are unaffected. There is still ample growth opportunity. And if we look at this rather complicated but very informative slide, we have highlighted in green here our producing fields, and we have a number of potential oil fields in various degrees of exploration, where we have prospects ready to drill, but also leads that are currently being matured. And we do see ample opportunity for exploration growth, in addition, of course, to continuing our production from Blocks 3 and 4 for several years to come. One of the most important numbers for an oil company, of course, is the asset base. Exploration growth is maybe necessary for the future, but the asset base and the current reserves for us stand at just over 26 million barrels in December 2019. And it's from those reserves that we derive our production, which has been on a daily basis between 12 and 13,000 barrels of oil per day for several years. And in the early parts of the year, we were at 13 or thereabouts. Limitations were introduced in May. We dropped down here to above 10,000, and we have been reasonably steady at these levels for June, July, and also August. We have guided that we have limitations, but we should remember that there will be monthly fluctuations, and we do not currently guide for what the exact number is going to be for the rest of the year. But it's from our production that we get our revenue, and our production comes from our reserves. And we have sold and produced over 4 million barrels since 2016. And this is, of course, a tricky part for an oil company. If we produce our reserves, eventually we will no longer exist. It is a depleting resource. So one of the most important numbers to check on the health of an oil company, it is the reserve replacement ratio. And of course, the trick here is, in order to continue to grow, that you increase your reserves by more than you produce. And we have been able to do that since 2013. We've always come in above 100% of the production we've had. And in 2019, we did 116%, whereas in 2018, 177%. And that reflects a little bit on what has been the focus. In 18, we were focusing on exploration. We saw development in 19, where we brought those reserves on stream. And as I've been saying, we see ample growth opportunities still within Blocks 3 and 4, where a discovery can be brought into production very quickly, but also in our exploration blocks 49, 56, and 58. But of course, it's the production that translates into revenue, And in 2019, we sold oil for $150 million. First quarter of 2020, we sold oil for $37 million, and that dropped down to 21 in the second quarter. But it's still a substantial number, $20 million worth of revenue, which translates into our cash flow. When oil was in 60 and above, we have saw cash flow, EBITDA, I should say, of more than 100, close to 100 in 2019. A healthy $21 million of EBITDA in the first quarter of 20, dropping down to a still substantial 8.7 for 2020, for the second quarter 2020. And then we should remember that that was a very bad quarter for the oil industry. And obviously, the net back from each barrel we sell is very dependent on the oil price. And we see as it has come down, so has this area here, but we're mitigating it to a degree by cutting down on expenditure. So our operating costs dropped from $11.6 per barrel for the first quarter down to 10.8 for the second. And distribution to shareholders has been a very important part for us. And of the cash we have generated, we have been able to distribute through dividends, through a share redemption program, and through buybacks, increasing amounts, cut back a little bit here in 2020, given the situation that we have come into. But as I said, more than $120 million has been returned to shareholders, while we have been able to continue to increase our reserves every year and maintain a slightly increasing production. So with $60 million of cash, and the drop from the first quarter is almost entirely due to the distribution to shareholders that we saw in May after the AGM. So with $60 million of cash, with a still positive cash flow, and with an interesting growth program, we do believe we are very well placed to continue to deliver interesting returns, and in particular also growth to our shareholders. We've just signed a new exploration block. We are ready to drill. We continue to generate cash. Our production stands above 10,000 barrels of oil per day. We have $60 million net cash. We continue to explore, we produce, and we are open for other projects if those should arise. So if you do believe, or if you want to have an oil company in your portfolio, and one that has been able to give a very handsome return to shareholders since 2014, but also offer growth opportunities and potential to find more oil and increase production, I do believe that Tethys Oil could be a good choice. Thank you.
Thank you, Magnus. I, of course, have a few questions based on your presentation. First of all, addressing the continuous growth in the 2P reserves, you being able to more than replace your annual production. How do you look at the potential for yet another year of positive reserves replacement?
Well, it's certainly our goal to continue to maintain more than 100%. And given the deferral of some capital expenditure, I would still say that the exploration part and also the production part is pretty unimpaired. So we obviously no guarantees, but we are hopeful that we will continue to find more oil than we produce, also in blocks 3 and 4.
Sounds good. And in terms of exploration, and what should be the pace that we're looking for in the years ahead? Of course, this year you're looking at the theme, call it frontier exploration well. Is it so that one frontier well per year is the run rate? And is it so that oil prices and, of course, cash inflow will be dictating the pace of the exploration program?
I think it will be a combination of them all. We hope, I mean, obviously, in blocks 3 and 4, it's a partnership where we are partners with the operator CCD, with Mitsui and ourselves. And it's a function of both where we are on the production side and also and how quickly we mature prospects, etc. There's not a set number of wells, exploration wells, that we expect to drill. We have historically seen fluctuations where certain years had a more focus on exploration, and then we're focusing on bringing that exploration to market, more on development. So I would say we are certainly hopeful to see several exploration wells a year drilled on blocks 3 and 4. And on top of that, of course, comes our other blocks, 49 and 58, that we operate ourselves, where we will do the work needed to 49. We're now ready to drill a well. 58, we will do the exploratory work and we'll be ready to drill wells probably over the next couple of years. 56, we have 20% there. We would be hopeful to maybe see a development from in the somewhat near term from the wells that have tested positively. Of course, it's also a function of oil price and available investments. But also, we will be ready to do more seismic and to firm up additional prospects there. So I think the core area will remain 3 and 4 until we have a large discovery in one of the others, if we ever get one. But with a combination of shall we say, a steady and measured exploration program in 3 and 4, combined with the growth blocks, the exploration blocks 49 and 56 and 58, I do think we will offer a very interesting exposure to finding more reserves over the next couple of years.
Yeah, absolutely. But on blocks 49 and 58, of course, you're 100% owner and the operator. Do you expect to retain 100% stake, or is it natural to assume that you will be farming down as we go along to reduce your, call it, exposure to any single wells and associated costs?
Indeed. I mean, 100% is a lot. We certainly enjoy being the operator. It's perfectly possible. I mean, everything is open for negotiation and for sale depending on the price and depending on the circumstances. It's possible that we would have a partner at some point in the future. It's also possible, say, that we drill block 49. It's a large discovery. Well, maybe we want to go at it alone, or maybe we will, for a good price, then ask a partner to join us for the development costs if we are successful. So everything is possible here. We will certainly keep you and the market informed of any formal steps that we take. But for now, the portfolio looks as it is, and depending on how the work program evolves and also what happens in the world around us, things can certainly change.
Sounds sensible. And then the last question from me relates to your substantial cash balance. Could you please highlight priorities for use of funds that you have on your balance sheet? Could you rank dividends, frontier exploration, the lower risk organic growth opportunities on blocks 3 and 4, and lastly, further M&A activities? If you could rank those 4.
Okay. Thanks, Gottfried.
Very good.
Lovely. Okay. Shall we say that obviously all 4 are of interest. Start with the last, M&A opportunities. We are constantly screening opportunities, but we are keen to find opportunities where we believe that they actually contribute value. I mean, just say buy somebody else's production to have more production that doesn't really create any value for our shareholders, we are less keen on. And that has translated into taking on more exploration blocks where we believe that we do have an edge in Oman exploration today, and we believe that we know maybe more than, well, many other oil companies, certainly in the world, about the opportunities there. And we believe that then for the cost of a seismic campaign and the relatively small cost of drilling a well, I mean, we're looking at millions of dollars per well, we can offer a very good risk reward for offering growth. If it's a dry hole, it's a small amount of cash out. If it's a discovery, it could be transformative. So whereas for us to do an M&A deal, it would be something that we would really see would benefit our shareholders greatly. Certainly, there could be some risk in there, but we don't want to jump into something that looks iffy or sketchy. We have enough use for our resources in Oman. And looking at exploration, well, I mean, obviously, as you have seen historically, distribution to shareholders is a very important part. We have a financial goals of keeping zero cash balance for the long term. So certainly, it's a high priority to continue to distribute to shareholders. While, as I pointed out, I mean, if you produce more than you increase your reserves, then you will eventually disappear. And well, sooner or later, that will happen to all our companies. But we believe there is still some years to go. So I say we will certainly prioritize distribution to shareholders, but we will also prioritize being able to maintain our reserve replacement ratios, while long term going for a zero cash balance. I hope that was a reasonable way of ranking.
Yeah, I understood it. It's, of course, a tricky one. We're running out of time. Thank you so much for your presentation, Magnus. Clearly interesting outlook while holding a conservative balance sheet looks like a very good business model in the current market environment. So thank you for your presentation.
Thank you very much.